All right, today we're going to talk about some of the original commentary and podcasts and also the most popular articles or the ones that stood out to us the most on Validea's Guru Investor blog for the week of April 30th, 2021. And to start, Jack, I'll let you kind of talk about your article on low volatility stocks.
Yeah, low volatility is, for me at least, I don't know if it is for you as well, it's like the hardest factor for me to get my arms around. Because it just doesn't, it doesn't make sense on the surface. You shouldn't be able to invest in stocks that are lower volatility and either get an excess return or get the same return. So either way, it seems to violate the laws of finance that you can invest in these stocks, and that it works the way it does. But it does work. I mean, the data over the long term shows, low volatility is a solid factor. It has solid evidence to support it over time. So what I want to do in the article is sort of for my own edification. I wanted to maybe revisit low volatility and talk about some of the reasons it works and some other things around it. So, the idea with low volatility, why it works is there's a lot of different explanations as to why it works. But the one I highlighted in the article is many investors can't use leverage. And so what they do is if they want to juice up their returns, they end up buying these higher volatility stocks in order to juice up their returns. And what that does is that overprices the higher volatility stocks relative to the low volatility stocks, and it creates an opportunity inside of low volatility stocks. And then the other thing I wanted to look at the article is sort of the idea of, if you're uncomfortable with low volatility like I am, it tends to work very, very well when it's combined with other factors. So, I highlighted some of Pin von Vliet's research that showed, that if you combine low volatility with value, when low volatility stocks are cheap, that's really the time you want to be invested in low volatility stocks. Or he has a separate article, which is actually a strategy we follow on Validea, where he looked at combining low volatility with momentum and high net payout yields, and showed an excess return there as well. So it's a factor that works very well with other factors. So if you're not completely comfortable with low volatility, you might be able to introduce some other factors and get some of the low volatility benefits while also, feeling more comfortable that you have other factors in the picture. So that was my idea. I just wanted to take an in-depth look at low volatility and maybe for my own edification, some of the reasons behind it, why it works, and some ways it can be used in the real world.
Yeah, a couple things on that. Like when you look at the stocks that show up in these like low volatility type screens, there's a lot of really good companies in there. There's a lot of big name consumer staple stocks, and one of the pieces of research that I went back to after I read your article was some of the work that O'Shaughnessy Asset Management has done around some of the best performing sectors over time. And actually consumer staples is, over the very long term, one of the best performing sectors. I think it's the best, actually, at least from the time they ran it, which I think was up until a few years ago. Now, keep in mind, low volatility stocks over the last few years have really underperformed. They were doing really well, and then I think like 2 years ago, the relative underperformance has been pretty dramatic, which isn't surprising because all these types of factors go through periods of underperformance. But I think in terms of getting back to the sector thing for a minute, I think the rationale or maybe some of the reasons that they were pointing to was that a lot of these consumer staple stocks, they have pretty big moats around their business and profitability. And so I guess their profits are protected and they can maintain higher levels of profitability. So that might be one of the sort of more fundamental, actually reasons at a micro level, why low volatility at least has, tended to work well historically.
You highlighted a good advantage of low volatility, because one of the problems with a factor like value is you look at your portfolio and you're like, why do I own these names? These things are horrible. If you look at your portfolio when you use low volatility, you're going to see names you recognize, you're going to see decent quality companies, you're typically going to see names you're much more comfortable with. And so that might let an investor stick with the strategy more. And the only other point I would make is what you highlighted, which is because low volatility has struggled so much in the past couple of years, it's now in one of those situations I talked about before where low volatility and value have now come together. So low volatility has actually become cheap now. And so if you look at history, that's where you've gotten your excess return from low volatility, is when it was coupled with value. So this actually might be a decent opportunity in low volatility, given that it's underperformed during this market run. What was our podcast this week?
So we podcasted about an academic research paper titled Migration, which was written by Eugene, Fama, and Ken French. And what the paper tries to get at is what are the actual drivers of the size and the value premium over time. And what the paper sort of keys in on, which is basically the title, is that stocks migrate across different areas of the market. So if you look at value stocks, for example, they constructed value stock portfolios neutral value stock portfolios, and then a growth portfolio, growth, neutral, and value. And so when value stocks had multiple expansion, which is one of the contributors of stock returns, if your stock's multiple expands, then that means it's going up in price relative to its book value in this case. So when stocks migrate from the value to the neutral, or maybe even to the growth portfolios, that is a major driver of the return in value stocks, or contributor to the value premium, where as growth stocks that go the other way, so growth stocks that go from growth to neutral or from growth to value, that's a negative, that produces basically negative returns or reduces returns. So this paper was about trying to get at like what are the drivers in both the size premium and the value premium using this concept of migration.
Yeah, what I liked about this paper is it sort of made why value stocks outperform easy to understand. We all tend to, those of us that are quants tend to say, here's our risk-based explanation and here's our behavioral-based explanation. But, this was a much simpler way to look at it, which is basically, typically with value stocks, the problems the market is anticipating, the problems aren't as bad as the market thinks. And what happens is over time, the PE ratio or whatever ratio you're looking at, the multiple on the stock goes up, and, stocks migrate, the successful stocks migrate from being value stocks to either being, sort of middle of the road stocks, or they migrate to, in more rare cases, to being expensive stocks. And that's how you make your money as a value investor. Things aren't as bad, the multiple goes up, you migrate, and that drives a lot of the value premium. So I thought it was good. It was a simple way to explain what's going on.
What article jumped out at you this week?
The post was called "Hedge Fund Short Trade Collapses While Longs Rise," and I think this is an interesting thing for all of us to think about with what's going on in the market right now, because this whole GameStop situation had a side effect in that it's really affected the willingness of people to short stocks, and so short interest is sort of falling across the market now. There are less shorts because shorting is really tough, because you can lose, as a long you can lose 100% of your money, as a short you can lose many multiples of your money, and so but short investors do they do the market a service because they identify frauds, they make the market more liquid and efficient. They do a lot of good things for the market, although they get a bad reputation. So I wonder what the impact of less shorting is going to be on the market. I don't have the answer, but I wonder what the impact is going to be going forward. And I think it's probably not a good impact. I think we want short sellers, and I think it's a bad thing that more of them are going away.
We just did a podcast on value traps. And while we don't use it, one of the metrics that a lot of people do use to try to identify value traps is high short interest. And we actually have a partnership with a professor who uses short interest as one of his criteria to try to avoid basically companies with problems. But I do wonder if this the level of short interest across the entire market is going to fall, and it might make that measure of using short interest as sort of a negative screen less effective and less valuable potentially.
That's really interesting. I hadn't thought about that, but that's true. If you have short interest falling across the market, that may change. That may be like a step change in how that works. The other thing with that is, obviously that negative screen, which a lot of people use, obviously in 2020 was not, that was one of the best predictors of outperformance, because these high short interest stocks got hit, went up so much. So it's interesting that, over the long term, that's a great indicator, high short interest. But in 2020, it was the exact opposite. It was a great long indicator just for that year. What was your article?
So it actually was a webinar with Joel Greenblatt of Gotham Funds and Richard Pzena of Pzena Active Management. And it was these two guys sort of having a conversation. There was a moderator too in there. And it was just, these really great value investors talking about, value investing in value stocks. And I'll just read a couple things from our summary of it, because it was these kind of capture, I think, some of the interesting things. So as to whether value investing is dead, Pzena rebutted, value is not low price to book. That's a factor. Value is a philosophy. It can't be dead. It's buying something for less than it's worth. He also said that a lot of people are talking about the last decade being anti-value. But what he pointed out was the last 10 years have actually been a normal decade for value stocks in terms of their returns. The returns over the last 10 years were the same as the returns a decade before that and a decade before that. But what was different was that growth stocks just basically went nuts and outperformed value. So that's just interesting to think about. And I think Wes Gray, who we've had on our podcast, also pointed that out as well. Greenblatt was in here basically saying, he offered data to illustrate his optimism about the opportunity set that value investors had. He said in 2019, 359 companies with market caps of over $1 billion lost money. If you just bought those companies in 2020, your median return would have been 65% and your average return would have been 120%. And then he quipped, and that's the world's worst investment strategy. So he's just highlighting how, all these companies that lost money, how well they did, and basically saying, that can't go on forever. And when the party ends, it's probably going to be good for value stocks. And so we'll link to this, but there's a bunch of other things too. It was also interesting when Pzena was talking about when they first launched the firm, which was in the late 90s, how much of a degree of underperformance they had versus the S&P 500 because it was all the technology stocks and the growth stocks that were outperforming. And he was kind of joking. He's like, they would come to the office every day because they were underperforming so dramatically, and they were asking themselves what are we doing with our firm, and are we going to survive? And then in 2000 it was something crazy where basically in 8 months, because value stocks did so well, they basically walked down all of that underperformance. And then we know from basically 2000 to 2007 was a golden period for value stocks. They did so well. So I just thought that was an interesting thing as when he first started out, basically as one of the worst times in the world to launch, a new firm around value investing, and yet they survived, and now they thrive. So yeah, that was my article.
Yeah, that point about a lot of the returns for value coming in a really short period is why value is so hard for many people to follow. I mean, we just saw that. We saw a decade where value was just horrible, and then we saw a 1 year period where you got a massive excess return. So, it's so hard to sit there and struggle for a decade in order to get that huge return. And, a lot of value investors over the course of that decade probably abandoned the strategy and missed out on the return. And that's why it's so, although value is a very sound long-term strategy, it can be really difficult to follow because of that nature of its return.
Yeah, it's a very good point. So thank you guys for listening to this episode. We'll put links into here to all these posts, and we'll see you next time.
Thank you.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.